This is the third quarter of 2019 Quarterly Context webinar for the clients and friends of the advisory group. My name is Greg Patterson, CEO of the firm, and these Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients make their best decisions and achieve their goals. We try to keep these meetings to about 20 minutes, and we will circulate a link later should you like to view it again or pass it on. And if you have any questions, please submit them to the information box. One note for today is that we are shifting to a bit of a different format where the first section of the presentation will be a little bit more high level and brief for those that want a quick review, and then we have a second section with more details for those who are interested in going a little deeper. As always, we like to remind people to focus on the intersection of what matters and what you can control. For example, markets and economy and the weather are things you cannot control, but you can control how you respond to them in the context of your long-term goals and your planning. Markets, as a quick overview, for the third quarter were mixed, with the U.S. market up just over 1%, international developed countries down about 1%, emerging markets down more pronounced at 4%, and global real estate up almost 6%, and bonds particularly strong relative to their normal returns, just over 2% and almost 3% for international, and in particular at the year level, over 10%, considerably above the long-term projected and expected returns for bonds, but primarily driven by concerns about the economy and some flight to safety from the average investor. It's notable that the S&P 500 was up nearly 21%, or just over 21% for the first three quarters of 2019, one of the strongest first three quarters in quite some time. As we'll talk about in the detailed section, however, the view of those returns should be tempered by other economic factors and some concerns that should lead to lower average returns potentially over the next cycle. You can see in the table here what the average quarterly return, quarter, not annual, is as perspective compared to what you see here at the top for the current quarter, as well as what the best quarters look like going back about 20 years and the worst quarters for some valuable perspective as a reminder of what a high and a low could look like, because those highs and lows or something like that will certainly happen again over different cycles. The news for the quarter always has some short-term impact on the markets, and this quarter was heavily driven by tariff news, tariffs on, tariffs off, tariff talks on, tariff talks off, Brexit, hard Brexit, soft Brexit, will Brexit happen, what will happen, and so forth. So those short-term news elements can really bump things around, but when you place it in the long-term perspective, any given news element tends to play a small part. Given that the U.S. economy has been a little bit more solid and continued to grow compared to other countries around the world, thought you might like to see some of the perspective of one driver that could be relevant there, in addition to whether it's in particular the stimulative monetary policy, which has really tried to stretch out this bull market and keep the economy on an even keel. The other elements is that there are really major economies and a relatively strong consumer sentiment and spending within the U.S. So, for example, the state chart here, the number under each state shows how each state would rank relative to the overall ranking of countries in the world. So California would be the 6th largest economy, Texas would be the 10th, Florida would be 17th, and so forth. So quite a sub-story here that helps understand the broader story. If we look at valuations based on the price earnings ratio, which is a measure of historical or current price relative to earnings compared to the past, these bars are the range of return, or PEs rather, over the last 25 years. The diamond is the current, and the purple box is the average. And what you can see here is that in general, the diamond shows up right around the average. In other words, not too far off long-term average valuations. If you look at a 10-year chart that we'll see later in the details section, the valuations look a little bit higher. And if you look more specifically at something like large cap US growth, it's at the top of the chart. So some valuations in some sectors seem to be relatively stretched. However, earnings with some of those large tech-related companies continue to be quite strong. A chart we've shown before, but are pulling it into larger size for your view since it's getting more attention lately, is the yield curve. The yield curve shows the shape of the yields on different maturities of bonds across different dates. So you can see how the yield curve has changed. And a more traditional shape of the yield curve was back in September of 2018, where investors are paid lower interest rates on shorter term bonds and higher interest rates, although tapering off in terms of slope, for longer term bonds. About a year ago, the yield curve had a partial inversion and then a more complete inversion. And what an inversion is when there are shorter term rates that are for example, at the beginning of the curve here, that are paying a higher interest rate than some of the longer term, medium or longer term, for example, the 10-year. The 10-year is a common point of comparison for that. So you can see here that in June, the curve overall shifted down and had an inversion, and for September, shifted down further as overall rates dropped. And also the relative, these dotted lines show where, for example, the short-term rates here are above the 10-year number, and that's where it tends to be, some would say, more predictive of a recession. In fact, if we look at the last 5 or 7 recessions, all of them were predicted or preceded, at least, by an inverted yield curve. The question is, how long will it take, and will it be predictive this time? Historically here, you can see the last 5 recessions had about a 18 to 20 month period between when the yield curve inverted and when the recession began. And you can see the range here is from 10 months to 33 months. So we're not making a specific prediction, but at a minimum, these charts tend to say essentially that we're at the late stages of the economic cycle, and what and how exactly what will happen next is, of course, unpredictable. But we encourage people to be reasonable in their planning, not to be overzealous in their expectations about markets, and a proper planning process should already consider those factors. Another point of perspective is how surveys of business leaders, and there's a Vistage CEO Confidence Index you can see here that has had a similar shape to the economy over time and has tended to be a little bit predictive or a leading indicator of what's next. And currently, confidence has dropped off a little bit, which, if the past is any indication, may mean that the economy will cool. However, that is already a broad consensus. The question is, how much will the cooling be and how fast? We've shown a few different business cycle charts in the last couple Quarterly Context webinars. Here's a different one as well. This one from excuse me, ITR Economics, where you've got recovery periods, accelerating growth in green, slowing growth in yellow, and recession periods in red. And what's, of course, not every sector of the economy has this is at the same stage of the cycle overall, but overall we seem to be at the late stage of the cycle and some of the cooling pattern, and you can see where the different sectors are shown here. And there's some suggestion that housing may be cooling faster and that foreign economies are struggling and cooling faster. What this can also mean is that if we think back to the context of U.S. market returns versus, for example, international market returns, foreign may be the first in line to get recovery while the U.S. may be entering some sort of cooling. Of course, the timing is unpredictable. In terms of behavioral finance for the quarter, there are a number of studies that try to measure how the average investor does versus the broad markets. One of those studies in companies is Dalbar, and the most recent study shows that for 20-year periods, that for example, considering stock markets, the S&P 500 had a 5.6% return, and we'll get back to that specific number in a moment, versus the average stock fund investor at 3.9%. So that's a difference of 1.7%, or 30% less than the market. And for bonds, it's even more dramatic, 4.6% for the broad market index, a 0.2 average bond fund investor return, or a 4.4% return difference, which is 96% less. So a couple of notable things here. This 5.6 20-year S&P 500 number may surprise some people, especially given that the average stock returns over the past 5, 6, 7, 8, 9 years have been 2 to 3 times that. Well, those 2 to 3 times are not normal. The projected return for the U.S. market on a 10-year basis, based on Callum Associates econometric forecasting, is at about 7%. So not actually dramatically above this 5.6%, but there are periods where markets have weaker average returns. If you think about the last 20 years, it includes the dot-com crash without including the full run-up of the dot-com boom. So that's part of why this number would be a little lower, because it's not including the full cycle over a longer time period, but a 20-year period nonetheless is an interesting period to look at. For bonds, some of these numbers may be that the average bond fund investor includes people who are in money market funds and cash, essentially, and so that can really, you miss out on bond fund returns. Also, this 4.6% is considerably above, contrary to the S&P 500 number, considerably above the projected return, which is just over half that number. So this was a period of monetary tightening after the 70s, still ratcheting down interest rates after a hyperinflationary period in the U.S., and that bringing down of rates really pushed up bond prices and gave bonds a boost over a period. But this is not a normal, really long-term return or projection over the near term, especially given where low rates are now, without any expectation of a lot of rate increases in the short run. What may be most interesting is that over the same time period, a 60-40 globally diversified active and passive portfolio, this is based on taking a sampling from 401k plans we help, was 6.2%. So it was above both the full bond and the full stock market returns shown above for that time period, because there's diversification, there's rebalancing, you're benefiting from different markets, even though some were considerably higher and lower than the numbers above here in any given time period. So the overall lessons and reminders are that being an emotional investor harms results. These factors don't even consider tax consequences. So if you're a taxable investor, and some of these people who are pulling their money in and out of the market, trying either because of fear or greed, functional spendable returns are lower because of taxes. And the other thing is that bonds are not just about returns. There are difficult time periods where bonds are really important as a cushion, so it should not be only thought of as a bonds as a return source. And some people have forgotten that in these really strong equity periods, but you will be happy to have some of that cushion when things follow the inevitable cycle of volatility over time. For the 401k corner this quarter, a few tips for fiduciaries. Won't go into the details here. I'm happy to circle back with you, one of us from the advisor group, that if you are an institutional client, if you have or are considering target date funds, which are a growing part of oops, hang on just one moment. Looks like we had a screen sharing issue. I'm going to make sure we get this back up and running. There we go. The DOL and the Employee Benefit Security Administration released guidance about how to think about target date funds and what to consider, and to essentially actively encouraged plan sponsors to consider custom target date funds where it might be possible. So happy to talk to you more about this, but essentially you want to use a process, have proper analytics, proper due diligence, and document the process to ensure A, that plan participants are treated as best as possible, and B, that you are protected as fiduciaries. For the personal wealth corner, there are sometimes concerns and data that shows that for families of wealth, that wealth doesn't persist over multiple generations. In fact, despite the heavy inheritances and transference of wealth that the next generations receive, studies show that 90% of the wealth evaporates over 3 generations. There are a combination of reasons that happens, but ultimately it's a shortage of financial literacy and planning, and that's where parents, even of adult children, can make efforts to ensure that their kids, teens, and adult children are developing effective patterns to help preserve wealth for the generations to come. Some of the discussion points that can happen regarding well-being factors that are in the context of wealth are elements of how to treat it, save, share, and spend. What can the impact on children be? What those well-being factors are, and when it's all done properly and on a coordinated basis, and there's no perfect way to do it, but in general, when children have even adult children, a more appropriate perspective, they tend to spend less, communicate better, be less material focused, and have higher self-esteem. So all very worthy goals that can be a result of having healthy money discussions early on an ongoing basis, and having an advisor help structure and facilitate that can be helpful, because it's not always easy for parents to do it by themselves. So with that, we'll conclude the first section of the presentation, and we appreciate you joining us. We always want your feedback. If you have ideas about how we could make this presentation better, topics you'd like to hear, elements regarding our services, our goal is to delight you, exceed your expectations, and help people live their best lives. And we look forward to any feedback you have. We also are very appreciative of those of you that have introduced us to other organizations and people who we can also help serve. So thank you for that. With that, we're going to continue on to section 2. If you have had enough and the level of detail that you like, feel free to sign off now. Otherwise, look forward to having you join us for part 2. Let's jump in. So the 4 bad bears chart is shown here. That shows the update of where the current market is on an inflation-adjusted basis versus the other 4 worst crashes and recoveries. The oil and financial crisis of the 70s, the Great Depression of the 70s in gray, the dot-com crash and recovery in green. And you can see on an inflation-adjusted basis, the current market is way above. Here you can see that December drop, or the fourth quarter rather drop of 2018, the big first quarter recovery, and then some bumpiness along the way. And we would expect more bumpiness and at some point some cooling. Volatility has picked up a little bit, as you can see, based on the VIX index, which some refer to as the fear index. And there's a number of elements that are going on that are increasing concern and discussions, as you've probably heard in the press, about what's next and what the status of the economy is, despite having such a strong first part of the market in terms of U.S. equity returns in 2019. Some of that stress and questions are coming from the tariff trade talks we talked about. Those trade stresses, by the way, tend to become more acute the farther you are in the downside of the cycle in terms of the business cycle. As I'm sure you are fully aware, political stress is increased. That increases uncertainty. Manufacturing data is cooling, which relates to concerns about growth. Brexit that we talked about before. The result is that has pushed bond yields down to levels that we haven't seen since 2007. Some would argue that some of the yield curve element we talked about before has been driven by the buy-up of bonds in terms of stimulation, but we don't believe that's the bulk of the issue. The Fed did cut rates, supported the repurchase market, which is essentially the overnight plumbing of the financial system to help make sure things run smoothly. That hadn't happened in a while. Europe cut rates, as did a few other countries, and again, so a number of elements that are late stage cooling type factors that are raising concern and in general about what might be to come in terms of the shape of markets and returns. But again, that's part of the natural cycle. In terms of the few key indicators, GDP was up, but is expected to slow. We're still in the longest expansion on record. Rates were cut a couple times during the quarter. It's stated as a recalibration of policy versus an attempt to really do a heavy stimulation. And I think the big question there is some would argue that should not be happening, that there shouldn't be cuts, there should be raising rates so that there's more dry powder so that when the recession does occur, the Fed has more power to stimulate that. But others would argue that it's better to do that in advance. So only time will tell whether or not that's been a good decision. Inflation remains stubbornly low. That's a bit of a concern for the Fed. It's now below their target in terms of the PCE index as well. It's been below before and not in recent quarters, but continues to hover there, which is part of what has pushed them to do some stimulation if they don't want to. They want growth and inflation to taper off too much. We're trying to sort of maintain relatively stable economic status. Unemployment up a little bit, but not much. Wage growth ticked up, but still considerably below the long-term average. We talked about consumer confidence is relatively high, although it came down a little bit. Oil has been volatile and slid. Currency, the dollar gained in the short run, and there continue to be geopolitical factors that raise uncertainty and increase stress. In terms of some of those factors in a longer-term view, you can see unemployment here, what the chart has been, and it's starting to flatten out a little bit here. Inflation remains at that low level. The dollar has been volatile, cooling, picking up, dropping off. The consumer sentiment has begun to flatten out a little bit and cool. The price of oil, again, volatile, but considerably lower than it was just 10 years ago, or a little more when it had a spike then and a spike about 5 years ago. So just some broad perspective there. In terms of the debt scenario, consumers and corporate, household debt, one thing that's good news is that household debt is lower than it has been in quite a while. So that suggests there could be resilience of the consumer and less overall stress for when times do get a little tougher. You can see even pre-dot-com and pre-global financial crisis, consumer debt was, the debt ratio at least, was considerably lower. Overall household net worth has gone up. That's a function of both real estate and 401k accounts and the long bull market and so forth, and also this lower debt ratio. The federal debt, on the other hand, has picked up speed and is projected to continue to grow. And the corporate bonds has been essentially an explosion in corporate bond issuance, and it's somewhat of a lower quality level, and that's raising some concerns about a potential hiccup in the future. For the quality view this quarter, rather than showing you the traditional quality thermometer squares, I thought you'd give you a different view, not entirely focused on quality, but some quality elements embedded here. And specifically, you can see that if you divide this up by sectors or sectors and kind of investment groupings, maybe better stated, there's quality, momentum, cyclical elements, high dividend paying, multi-factor, defensive. And you can see that in general, quality and defensive, which tend to do worse in hot, high charging momentum markets, have been hovering in the lower half, but are beginning to work their way up a little bit. And those types of holdings tend to do better when markets get tough. And we try to build clients for portfolios in a way that contains and maybe has a little bit of a tilt towards the quality element, so that the volatility is a little bit less pronounced when markets get tough. Investor behavior in terms of some data around the finance. Again, you've seen these numbers going farther back. More recently, there's been some outflows out of U.S. equity and even world equity, given some of the concerns. And a lot of that seems to have been pumped into taxable bonds just at a time when the bond market is also getting a little bumpy, although has had some reasonably strong returns in the short run, and that may provide some overconfidence to people about what bonds can do in the long run. A lot has gone into cash. Look at those numbers, $300 billion into cash. And if history is any guide, people who've pumped big chunks of money into cash and bonds will regret it, because they will miss out on the long-term upside of a more balanced portfolio. Here we see the chart I referenced earlier about valuations. Same chart here, so you can see that in perspective relative to a 10-year chart. And this is the large cap growth PE ratio element that I mentioned, where at relatively high valuations compared to the last 10 years. And in general, in the 10-year, the numbers, the valuations look a little bit higher across a number of different sectors. That sometimes precedes a cooling, or at least a more normalization of returns. So that's why we talk about valuations, not to be predictive or tactical, but to help you understand that markets don't stay hot forever. In terms of rules and regulations for the quarter, some general updates. We've shown elements. There's been quite a few notes in the past several years about the deterioration of consumer protections, and that can lead, that type of deregulation historically tends to lead to higher volatility and higher magnitude downturns over time, for example, like the global financial crisis. And currently, the Supreme Court is going to be reviewing whether or not the Consumer Protection Bureau is a legal entity. So stay tuned for that decision. Social Security wage base increased recently. And in terms of retirement plans, there was a proposed regulation to make it more possible to have multiple employer plans. That could help the micro plans, in particular, those that really don't have access to any or don't offer retirement plans at all, because they simply don't have the bandwidth or the financial strength even to hire an advisor. So there may be some standardized plans out there for the micro plans that could be helpful for the average plan participant or employee. And we we talked about a couple of just reminders, not so much regulations, but we talked about the slide prior about what to consider when considering target date funds. And for foundation and endowments, it's important to revisit your spending policy, and in particular, when the capital market return expectations change. So we've been running through that with a number of clients, and that's led to some allocation adjustments. Again, as a long-term strategic, not as a tactical move. We've, as you may have noticed, have been spending more time writing content here internally. A team of people, our senior advisors, writing on topics that we believe are of interest to you. A lot of our clients are business owners and leaders, and so these blog topics address both personal realm and the fiduciary realm when you are responsible for different the financial outcomes to some degree of others. And so again, it's a lot about self and family as one category, others in terms of the plan participants and employees that you oversee and are responsible for impacting, and then communities, and oftentimes that's the community impact, the foundation endowment space where people are oftentimes on boards and contributing their time and energy, and in some cases funds, to help support community efforts that are important to them. So with that, we'd like to thank you very much for attending today, and we'll take a moment here to see if any questions come in. But thank you again, and please contact us if you have any questions.